The first financial statement we are going to look at is the income statement. The income statement, or profit and loss statement it is often called, tells you whether you made a profit, as that name, or a loss, as that name infers. But income statement is very commonly used. Earnings statement is similarly used. So we're going to look at a situation where we sold 4,000 units. We sold each for $5, which comes to a total of 20,000. And our standard cost for each is $4, so our variable cost is 16,000. This $4 is typically based on past data or estimates of what it costs to make a product. So we want to determine if that was profitable in some time period. So in this, we start with revenue. Revenue we said was 20,000, the $5 times the 4,000. We subtract out variable costs. Variable cost is $4 times 4,000 or 16,000. And we get what's called gross margin. Next, we take out fixed costs. Fixed costs are things such as marketing, salaries, corporate expenses. These do not change whenever the quantity changes. If you had really tough times and the quantity sold went down to 2,000, yes, there may be some layoffs and so forth, downsizing that would reduce these, but the number you have here isn't determined by multiplying times the quantity sold. It would just see how many people we laid off, how much expense we saved, plants we closed or whatever. Or it could go the other way, plants expanded. It has nothing to do directly with the quantity sold. In this case, the total is 1,400, so we subtract the 1,400. Depreciation is a way of allocating the cost of machines, buildings, and other assets across multiple time periods. For example, if we had a machine that costs $1,000 and it was going to be good for 4 years, work well for 4 years, that's an average of $250,000 a year. So we might say that's how we determine depreciation. There are other means which we'll look at in later chapters. So part of the cost of this product is paying for that machine, and we pay for 1/4 of it a year in this case for this example. And so we subtract out the fixed cost and the depreciation from the 4,000 and we get $2,350. That is what's called earnings before interest and taxes. Before interest and taxes should strike a balance, say yes, we have interest and taxes yet to take out. Interest is interest on loans of various sorts. It's tax deductible for corporations, so it has to come out before we compute taxes. So that's the reason it is on this statement actually. So if we had interest of 50,000, we reduce the pre-tax income becomes 2,300. And then we figure out taxes using some percentage typically. Here you see we use 0.2 or 20%. So it becomes $460. We subtract that, and our net income, our profit for this time period is $1,840. And that is the income statement.